Hello again. Well, thank you very much. I take the opportunity to thank you, Alex and Georg Marcos, for allowing us to be here. To be honest, I'm overwhelmed, talking nearby Tweedy, Browne, SIA, BWM. I'm a rookie, I don't know what I'm doing here, honestly. So thank you very much. I'm very impressed. So one word about our firm. I assume that not all of you knows us, but we left our firm, Best in Bed Asset Management, which was the leading value investor independent manager in Spain. It's a 30-plus-year-old firm. And unfortunately, with big sad, we left the firm in 2015. And we created our own firm. There were certain discrepancies between the owners ourselves. And we took the route to create our own firm to be independent. So now ownership and management is together, and that's the best way to avoid conflict of interest. We are the largest investor in the firm, so that guarantees the alignment of interest. We don't do anything else except investing, and as I said on the chat, we're looking for long-term investors that want to invest along us. It's a very lean structure. We have 3 billion euro under management. 30 people, including partners, working. So it's 100. The ratio is 100 million euro, and the management per person. That's pretty efficient. We have offices in Madrid and London. London is very humble. We just have 3-4 analysts. It's a research office, and the strategy is try to avoid to lose money, to make permanent losses of capital. That's the only strategy we have. And we implement that from the marketing point of view in the international fund, which is the backbone fund, is the one that's 140% return since the beginning. Iberia, because we are Spaniards and we take the advantage, we have an edge in that market, blue chips and managers. And by doing all this more or less, reasonably well, we believe in our model. From time to time we get an award. The importance of that award is that it has come after a year we have that 0% return. So I don't think the judges gave us the award by having a good performance in 2024, but I think they award us for having a true to label model, that in which we believe and that we want to develop. That's the all-time performance of our funds. It's 12 times the money in 22 years. That's a 12% annual return. You got here, it's gathered the best in bed performance together with Azvalor performance that has been in the last 10 years. And this is my investment idea. It's a risky business, to present an airline as a value idea, it's very risky. Perhaps the reason is that Ryanair is not, I don't consider it a traditional airline. The market gave us a chance in the profit warning they raised in April 2000 or June 2024, a year ago, and 1 year late, because it would have been much better to come here when it was at 13 and all the doubts around the firm. The company has now rebounded to 24, but then the company, the share tanked minus 40%. And we said, well, it might be an opportunity to have a look to a different business model in a crap sector. The airline sector it's definitely a very bad sector. It destroys value massively. But this is different. I mean, well, Ryanair, I hope you judge the firm as an investor, not as a user, because I know there are a lot of complaints when you fly on them, but you pay little. And it's voluntary that you try with them. No one forces you, and still you go there. So it's the lowest cost EU airline. They have just crossed a milestone that has never happened before. It's 200 million passengers in 1 year. 2025, because they closed the year in May. And they've got the largest fleet of Boeing 737 and now the MAX version. And incredibly, they've got net cash and a very good track record on returning capital to investors. And the corporate, led by Michael Lerøy, is just incredible. It's everything. It's oriented to create value to the passengers and to the partners, ourselves. So, they try to simplify and keep it simple. And this is the most important metric at the firm, is to keep cost low. I will compare this firm not with other airlines, but with other companies with a big fixed-based investments, assets. And the nature and the reason why this firm is very competitive, it's generating what they call economies of a scale shared. So it's a scale shared business where all the efficiency that you create by scaling up the business and being very efficient on the cost, you share it with your clients. And then that generates the spiral that you've got more clients, you're more efficient, and you've got that positive cycle. So I would compare Ryanair more with Costco or more with Amazon, which are in that type of business model of large fixed cost businesses. If you see in this slide, I mean, the competitive advantage is just impressive. I mean, the difference of the cost of, this is the cost of producing what they sell. It's cost per passenger, basically. So it's 35 euros compared to Wizz Air, which is another low-cost company based in Hungary. It's plus 54. I mean, it's just amazing. And the next one, which is EasyJet, is it's 2.4 times more expensive. So as far as this company keeps this low, they will have clients, and moreover, they are creating a new market. And I raise a question to the audience. If you have a ticket to go to Jerez in the south of Spain, my country of origin, wonderful city, 3,000-year history behind Jerez and wonderful drink. I'm sure that you have all drink sherry. And the ticket is 130, 140. Well, some of you may go. But if I tell you we've got a ticket at 40, many of you will think about, well, I have nothing to lose. 40 years, the ticket, let's go there. It cost me 60 euros to go airport to the Bahnhof by train, and then catch a taxi and go to the hotel, which is nearby here. So it cost me more to reach here than to go to Jerez from Zurich. So they are creating a new type of client. And this is the elasticity of price demand. The lower you do something, the more addressable market you've got. Highly leveraged business, that's why they're so dangerous. The load factor is what makes them profitable or not. The break-even load factor of this firm, it's on the 80s. Okay? If they cover 80% of the seats they offer, they will be net. And if above that, they'll make money. Consistently, in the last years, they have achieved a load factor above 90, 92, 93, 94%. And if you see on the last line here, the performance, it's impressive. You know, in the first decade, 95 to 2004, it was just 73. And they push it up 10 percentage points to 83. And today they are at 91, but probably they will push it up to 93, 94. So, I mean, the profitability of the firm is out of question because they achieve these large factor, load factors. Now, the other weakness of that business is the balance sheet. You've got large fixed assets that you have to finance. Normally, I don't know too much about what's happening in the US because we don't follow airlines, but the natural situation is that they're highly leveraged. You know? Because these guys, they've got net cash. And when you see this, you say, whoa, I won't get a flight. Probably they're not investing enough, you know, on maintenance, or they're buying crap aircrafts. Not at all. Exactly the opposite. They invest a lot and they're very safe. And after, you know, dedicating 1.6 billion euro to capex and paying back to us 1.5 billion euros in repurchasing shares and 480 million euros in dividends, they still have net cash. And the company is throwing 2.5 billion euro free cash flow per year. So that cash will probably be given back to the shareholders in the next years, but it guarantees that they can't grow and they can't develop a growth strategy and because they've got the balance sheet to do it. Now, they are the most competitive ones but it's the culture that really matters, because being number one, they want to widen the gap. I've reviewed presentations of this company in the last 10 years, which always fixed on the presentation is gap widens. Nothing is enough. We want to widen it, widen it, widen it. And so they order 300 aircrafts from Boeing when everyone canceled the Boeing purchases. So Mr. O'Leary, very smart guy, when Boeing was jeopardized and no one wanted to buy a Boeing, said, well, if you give me discount, I'll buy you 300 aircraft. And he got a 50% discount on the price list. Again, he was investing on being more efficient, and he passed to the shareholder, to the client, he passed that cost, reduction of cost, creating again that cycle, scale, efficiency, new clients, and so on. And that gives them the advantage of increasing, having the same routes, a 21% more capacity, with a 20% less consumption of fuel, and 20% more revenue opportunities. They also sell ancillaries. I think they sell stuff, you know. They're bothering you the whole flight, by the way. You know? Buy me this, buy me that, buy me that. And well, they get 40% of the revenues based on that. So, you know, being number one in efficiency, they've got this leverage to be more efficient. And, you know, on capital allocation, they were very smart buying when others were canceling. Uncertainty. You remember what we were talking before? Buying with others, sell. And they make it, but that's why I put the keep it simple. Always the same model of airplane. Because maintenance, operations, everything is very simple. I mean, the business model is 2.2 hours maximum, 800 miles maximum, 6 rotations, 6 jumps per day. When you've got a fixed base business, the additional income that you get, and to make 6 jumps in one day in the aircraft business is extremely difficult. That 6th trip in a day makes the whole difference, because everything goes bottom line. You see? They're running at full capacity at the moment, you know? So this is the increase of number of passengers they have moved since 2023. Okay, I go fast. From 170 to 300. And then, do they treat us well? Yes. Impressive, they have retired 36% of the shares issued. That's 9 billion euro. And very likely they will keep on doing that. And despite of that, they are paying a dividend. And 2 tailwind is that the stock has been included in the MSCI World Index. So for the, you know, for the investors that don't ask anything, they will be buying as well this share. The CEO is a leader, is keen in the game. He's got a package to own more than 1 billion euro of the firm. 44 million shares, has been there since 1994, so 31 years. And it's got a very strong corporate culture that, you know, goes to everyone in the firm. And the valuation, it's not anymore at 9 times. The stock went up to 24, so it's at 10 times earnings. Historical average has been 14 times earnings, and there are 3 leverage that could trigger a better valuation. First, expansion the multiple to the average from 10 to 14. Second, net profit growing thanks to these new airplanes that is going to increase the capacity. Third, improving the net profit by passenger. Today, currently it's at 9.5, but they could improve to 11 or 12. That you have to make your sensibility numbers there. And fourth is a lower cost of capital. The last one, if they keep on returning the shareholders by repurchasing shares, then it will be very interesting. The benefit will go up, the number of shares to distribute that will go down. Thank you very much.
Thank you, Beltrán.
Be good, Marcos, please.
Yeah. I mean, the first question, probably you responded it already, but you have 2 guys that we all know. One is Warren Buffett, the other one is Branson, that said that the best way to be millionaire is to start as a billionaire and build an airline. So, I mean, you bought very cheap. But are you going to stay invested on a compounding basis? You think it's a trading stock, or you're going to stay there for the long term, benefiting from the growth and prospects?
So no, we love the model, we love the people, and didn't mention, but the airlines sector has been built towards providers, you know. So all the value that airlines were creating was shared with providers, airports, engines, aircraft producers, by the way, oligopolies. You know, there's only two firms. These guys actually turn around completely the business model and say, no, my partner is the client. They have built the model towards the client. And the best I can give you, the more of you I will have, and I will create a lot of value for you, and I will keep just 10 years of your pocket money for me. So I create value, but indirectly has created massive amount of value to the whole industry. Ask Boeing, having a client of 300 when everyone was canceling. These guys, they have revived secondary airports that had no traffic at all, and Mr. Lerøy visiting them saying, if you don't charge me, I'll bring you 1 million people here. And nothing to lose. They say, you will make money in the shops and on the parking and on the ancillary. You know, I bring you people. You know how much a tourist spend on the destination? 1,441 euros in Spain. So if 200 million euro people spend that amount of money, actually he's handling a business of 320 billion euro to distribute. So based on that, we may stay in the firm for a while, and I think it's a compounding machine.
Okay, challenging the value opinion about the airlines, that is nice. On growth, Ryanair has been growing, I was checking the numbers, almost 20% for 2 decades.
Yeah.
Do you think the business model is changing towards lower growth, more dividends, more buybacks? Or you think the guy wants still to grow, I don't know, in the East and go to, he still, O'Leary, wants to keep growth?
Yes, but at the price. So he's doing a very smart movement on the same lines, on the same investments, just improve 20%, just buying new aircrafts at a bargain price, which is, it doesn't imply anything else. Just, changing the new generation by the MAX 10. So I think he's open to everything. He wants to remunerate. He's the largest shareholder. He wants to remunerate capital. He's going to do it like that. And at the same time, his biggest competitor with Air is in big trouble. It's highly leveraged. 1/5 of the fleet is landed because they had problems with the engines, with the Pratt & Whitney engines. And it's a big opportunity to cover the lines that these guys cannot cover anymore, and a firm that it's in a vice cycle. It's exactly in the opposite cycle as these guys. The debt it's increasing, the value to the clients is diminishing. Reliability of the firm perception is very bad. So I think he wants to grow at the price. He doesn't want to do what Southwest did in the United States, to turn. He wants to remain there.
Okay. So talking about Wizz Air is very cheap, having rough times. Do you think there would be Ryanair interested in taking over these guys?
Well, he tried to buy it before it went listed, it went public, many times. He talked to the American shareholders, and when it went listed, it went up to the roof to 6 billion euro market cap, and say, well, this is too expensive. A couple of years ago, 4 years ago, Wizz Air launched an IPO to EasyJet. And he said, if they don't merge and gain in efficiency, both of them will disappear. So probably he will buy the continent, which is the 65 million clients that they operate, which most of them may be common. And he's interested about the cost structure, because they are based in East European countries, and the only competitive advantage of Wizz compared to them in terms of cost, it's salaries, cost of. So I don't think he will do a stupid thing, 7 billion euro. And then another point is that is with Airbus. So there are no synergies there.
Right.
Okay, so the 220-something aircrafts are Airbus, not Boeing. He bought Lauda Air and Booth and killed the Airbus fleet, converting everyone into Boeing.
Right. In terms of cost, I mean, we're moving to phase of cost inflation in labor, in capex, and also maybe CO2 cost and CO2 credits, and then energy. Our call is that oil prices are going to go up. How is Ryanair going to do in an inflationary scenario? You think they can cope with that? You think it's going to affect the business, or they know how to react?
In terms of relative position, he will do, or the company will do much better than the others. So the gap will widen further. Oil is a problem for everyone. It's not just EasyJet. I'm sorry, Ryanair. So, and he's very active on hedging. I mean, I think that he has hedged like 70% of the fuel consumption in 2026, which is this year up to May 2026. He will do well in inflation. The problem is the other partner, the clients, will lose purchase power to travel. I'm very concerned as a part of this society how fast people is losing purchase power. And the social contract that the politicians talk about it is to protect them. And protect people who is losing purchase power is just tax. It's getting your money to give to someone else who cannot cope with their way of living. And this may affect, of course, may affect. But, you know, it's cheaper. We were with a very relevant president of a bank in Spain and say, Spaniards don't buy houses anymore, they don't buy cars anymore, and they have free all that money to travel.
Okay, then I think we are done with the.
Thank you very much for that.
Thank you.
James?
Thank you, Marcos. Thank you.
Okay. Look, thank you. First, I'd like to ask a question. How many people in the room own a pet today? Raise your hands. Okay, so a pet. Yeah, it looks like about 50% of you. So hopefully this idea will resonate with you guys. So today I'm incredibly excited to talk to you today about a company listed in the UK by the name of CVS Group. And CVS Group owns 470 vet practices. But for context, I think it would make sense for me to briefly describe Tweedy Browne's investment process. So the goal of our investment process is to buy companies at 70% or less of a conservative estimate of intrinsic value. With intrinsic value being defined as, what would the business be worth if the CFO of the company we're looking at picked up the phone and put the company up for auction tomorrow and sold 100% of the business, right? Not just a couple of shares, but sold 100% of the business. So we appraise value by observing M&A multiples paid for similar businesses, looking at multiples like enterprise value to EBITDA and PE. And as an analyst at Tweedy Browne, I spend roughly 25% of my time just tracking M&A multiples in different industries in order to build a frame of reference for the purchase price multiples that are typically paid by knowledgeable buyers in different sectors. It's very similar to the analogy that was given earlier, right? If you were looking to buy a house or you were looking to sell a house, one of the most important things you would want to know, what have similar homes sold for recently, right? You'd want to know what the comps are. And that's what we do at Tweedy Browne. Two other points I'd like to highlight. We insist on balance sheet strength. Look, we're frankly chicken when it comes to leverage. To give you some color, when we run screens for new ideas, we only look for companies that have net debt to EBITDA below 2.5 times. So we're generally investing in businesses that have investment grade credit ratings. And second, we're big believers in the efficacy of insider buying. We just think that it's a common sense positive signal when the insiders of the company are reaching into their own wallet and they're buying shares in the open market as well. So it's not just Jay Hill that thinks the stock is cheap. The insiders of the company are buying shares as well. We think that's extremely important. So CVS Group. This is a UK-listed company with a market cap of approximately 900 million pounds. It was founded in 1999, and today they own 470 vet practices. Now, 430 of those vet practices are in the UK, where they have approximately 9% market share. And then in late 2023, they entered the Australian market, and today own 40 vet practices, and they have approximately 1% market share in Australia. And then they also offer adjacent services that are related to the vet space. This is diagnostic labs, crematoriums, so you can say goodbye to your pet when it dies. They also own vet hospitals. But as you can see on the chart, roughly 90% of the EBITDA here is derived from the core vet business. Now, CVS has each of the attributes that I just discussed. So first, the stock is cheap relative to comparable M&A multiples. When we bought shares in CVS, we paid an average price of £10 per share, and the valuation multiple we were paying was 7.5 times EBITDA and a PE of 12 times. And we own 8% of the company today. In the last decade, there have been 28 comparable M&A deals of large corporate vet groups, not just one independent practice, but large corporate vet groups, purchased at an average enterprise value to EBITDA of 18 times. Second, we believe we paid roughly 55% of a conservative estimate of intrinsic value. If you value CVS Group at 13 times EBITDA, that equates to an intrinsic value of £19 per share. And the reason that we used 13 is that is the most recent multiple that was paid for a large corporate vet group. But it's a conservative number. We could have used 18, which is the long-term average. Third, this is a business with a low, modest debt leverage, 1.6 times net debt to EBITDA. And then fourth, insider buying. Prior to our purchase in CVS Group, 5 different insiders had reached into their own wallet, bought shares in the open market, and that included the CFO of the company and the chairman of the board. Now this slide here will give you some context. This is a 5-year stock price chart of CVS Group. And as you can tell, one of the questions you may be thinking to yourself right now, how was Tweedy able to buy a stock at 7.5 times EBITDA when the M&A comps suggest an average of 18 times EBITDA? Well, CVS's stock price, as you can see, fell from the mid-20s to a low of approximately £8 per share due to an antitrust investigation in the UK vet industry. I'm going to talk more about this later, but the investment thesis here was ultimately that this sharp stock price decline reflects the market's belief that antitrust remedies are going to materially impair the profitability of the UK vet industry. And we strongly disagree. We believe that this stock price decline was a material overreaction to regulatory uncertainty, and that there are logical reasons to conclude that any potential remedies will not meaningfully reduce UK vet industry profits. So this next slide here shows, look, we all know that the vet industry is a good one, and it benefits from 3 clear secular growth drivers. The first is just the humanization of pets. In my lifetime, I've observed how pets have basically moved from the backyard to the living room to the bedroom. My pet sleeps in my bed every night. And in many parts of the world, pets are effectively viewed as substitutes for children. There's this whole pet parenting craze that's going on, and that's definitely a positive. 2, medical advances leading to pets living longer. Dogs and cats are living longer lives today due to advances in medical technology. And 3, in the UK, just like I assume happened in Switzerland, there was a post-COVID pet population boom. So just to give you some context, in the United Kingdom, pre-COVID, there were 9 million dogs. Post-COVID, there were 12 million dogs, right? So a 33% increase in the number of dogs. And just like humans, medical spending accelerates as pets age. For dogs, this typically happens when a dog reaches approximately 7 years old. And from 7 until the rest of its life, there's a noticeable uptick in vet care spending. And so this creates an embedded growth tailwind towards the end of the decade as the COVID-acquired pets age and reach old age. So come 2029, there's going to be a big tailwind behind the growth of this industry. And then the vet industry is one that's resilient in economic downturns. I could quote a lot of stuff here, but maybe the best representation of this company, since it was founded in 1999, has had positive organic revenue growth every single year. This next slide just shows you the long-term track record of vet spending in the UK over approximately the last decade. The industry's grown at an 11% compounded annual growth rate. Other key investment positives that I'd like to point out. Over the last 12 years, CVS has had positive organic revenue growth rate on average of 6% a year. This is a business that generates high margins and high returns, 15-year average EBITDA margin, or 12-year average EBITDA margin, 15%, 12-year average ROE, 29%. This is also a business that year in, year out, generates consistent positive free cash flow, but it gets even better than that. This is a business that has the opportunity to reinvest that free cash flow at very high returns by buying independent vet practices one at a time, and then generating synergies from those individual practice M&A deals. This is the long-term record of CVS. I think it's self-explanatory. Consistent revenue growth, consistent earnings growth, highly stable, highly predictable business. I know you're not going to be able to read this. This is approximately over the last decade. There have been 28 M&A deals of large groups of vet practices that have sold for an average enterprise value to EBITDA of 18 times. So let's talk about the CMA investigation. So the CMA stands for the Competition and Markets Authority. It is in the UK. It's effectively what in the United States they call the Department of Justice, or the FTC, the Federal Trade Commission. It's the antitrust regulator. And this investigation stems really from two questions. Are UK pet owners being overcharged for vet services due to a lack of competition in the industry? And two, do UK pet owners receive enough information in advance to make informed decisions? And the CMA really had two key concerns that triggered this investigation. One is vet service inflation. So if you look over the last decade, the price of vet services has grown approximately 200 basis points faster than the price of overall United Kingdom consumer price inflation, right? So that's sort of issue number one. And then two, there's been dramatic consolidation of vet practices in the UK over the last decade. This pie chart shows you, in 2013, 90% of vets were owned by independent vets. 10% were owned by large vet groups like CVS. Fast forward to today, 60% are owned by large vet groups and only 40% by independents. And the CMA had concerns about this mix shift as well. Now, look, I don't have a ton of time to get into the CMA's full investigation, but it's a wide-ranging investigation into the vet industry. The vast majority of the due diligence on this name was interviewing former CMA lawyers that used to work on these market competition cases and asking them questions about what are the most likely remedies in this particular case. And those conversations really led to two things. There were really two potential remedies that truly matter to profits. So first is local market share. So where the remedy would be forced divestitures. So in general, the CMA doesn't want any local market where a large vet group has greater than 35% market share. So if it's a market with 3 vets, they don't want 2 of them owned by the same corporate entity. If you study where CVS's practices are, only 4% of their vet practices potentially violate this local market share threshold of 35%. And so if they were forced to divest these practices by the CMA, we think the profit impact to CVS would be immaterial. And then second, this is the bigger one, are UK pet owners overpaying for vet medicines? And the remedy here is price controls, i.e. the government telling vets what they can charge for pet medicines. And we think there were two primary reasons why this is also unlikely. First, CVS and the rest of the CVS, the large vet groups that they compete with, and also the independent vets have all publicly stated that if the CMA regulates price controls, any lost profitability from those price controls is going to be offset by price increases for other basic vet services. That's the best reason. The second reason is it's a well-known fact today in the UK, there's a chronic shortage of veterinarians. There's not enough of them. And so that any remedy that the CMA would propose that reduces industry profitability, that's going to further disincentivize future youth from becoming vets, right? It's going to make it less economically attractive to become a vet. And we think that's not the market signal that's not going to be healthy for the UK vet industry if there's just not enough vets. And that's going to exacerbate a problem that already exists. There's not enough vets. Thank you.
Thanks, Jay. Brings very
Yeah.
Thanks for bringing this very
that much.
thing
Is your mic
forward
working?
here. No, I don't think it's. You hear me now, huh? Okay, great. So thanks for bringing this very interesting call. My dog turned 5 yesterday.
Your dog?
So 2 years more before the bills will pile up.
Yeah,
just learned that.
In the vet industry, there's something called the smile curve. And in the first year of pet ownership, there's actually high vet spending, like vaccines, neuterings, things that happen in that first year. And then usually year 2, 3, and 4, you're in the healthy puppy stage. There's not as much vet spending. And then as you get to year 7, it goes like upward slope.
Well, that's my face. My kids and my wife will always keep smiling.
Right.
So you took the opportunity while there was this CMA investigation, but I would probably want to dig here once more. So these price controls that they'll probably will try to impose. I did some research and I saw that if you buy pets medicine online, you can buy that with a markup of 30-40%.
Yes.
And they charge, the vets charge 60-70%.
Yes.
So if they impose a tariff system with a markup of 30-40%, that would really destroy a lot of EBITDA margin. And that was your point, that offers the opportunity, and that probably was the main scare of the market. My question really is, they know that, the CMA also knows that they will try to mitigate that to other services, the price up other things. So they will keep an eye on that, don't they?
Yeah, I mean, look, I think it's incredibly unlikely that they're going to impose price controls, that they're going to effectively tell vets, this is the price you can charge. There's numerous complications. Are you going to tell the vet that operates in the middle of London, he's got to charge the same price as a vet that's in rural UK? That doesn't make any sense to me. It's also true that I think it is true that, and it's widely known, that vets have overcharged for medicines, but undercharged for other basic services. And one of the advantages of this is that a vet could explain to a pet owner, hey, the high prices you're paying for the medicines, that's the drug companies, that's the Zoetis companies of the world. Blame it on them. And I think that was a helpful excuse. But if the UK ultimately imposes price controls on the sale of medicines, it's very clear that the rest of the vets are going to increase prices for other basic services. You mentioned something else as well, that it's widely known in the UK that you can buy medicines directly from your veterinarian, or you have a choice. You can ask your veterinarian for a prescription and pay a prescription fee for that, and then purchase the medicines for cheaper at an online pharmacy in the UK. But as a pet owner, you have to know two prices. You have to know what's the cheaper price online for a medicine, plus the prescription fee, and is that price lower than the price that you would pay directly from the vet? Okay, but clearly the CMA wants more UK consumers to be aware of the fact that there are cheaper options to buy vet medicines away from your vet. But the bottom line is that the vast majority of the public knows this, but only few people actually purchase online at cheaper prices. They tend to buy from their direct vet. There's a perception amongst pet owners, and it's a wrong perception, that the price or that the medicines that they receive directly from their vet work better, that they're better drugs. Even though that's not necessarily untrue, but frankly, that's the perception. And most pet owners like the convenience of going into their vet practice, being told what their pet needs, buying it right there, and actually being able to administer to their pet that particular day. They don't want to go online and wait for a day. And the only true scenario where it makes sense for a pet owner to buy online because it's considerably cheaper is if your pet has a chronic condition like arthritis and needs that medication for the rest of its life. In that instance, it's in the pet owner's best interest to buy those drugs online for lower pricing.
Okay. I'm allowed to do two more questions, not only one. They insisted one.
Okay.
So, two questions. So the first one is, so 30% more dogs, same amount of vets.
Yeah.
That means there's a scarcity. And there are this corporate trying to take over all those vets.
Yes.
And they are in competition to the other corporates who are trying to do the same. So maybe what does CVS better than the others in terms of talent, retention, in terms of do they pay more, or is it more flexibility, training, culture? What is it?
So Pascal, that's probably my number one long-term risk factor here. There's a chronic shortage of vets. There's an arms race by all of the corporates. How can we recruit vets, retain vets, keep them happy, to really be the place where, if you're a vet, you most want to work for. And so what CVS, when they buy an independent vet, first, the payment is made as an earnout. So the selling vet doesn't get 100% of the money up front. They get, let's say, 75% of the money up front, and the remaining consideration is paid out over time as certain milestones are met. They make selling vets sign employment agreements to remain with CVS, at least for a number of years. There were also non-compete agreements that would prevent a selling vet from selling their practice to CVS and then turning around and opening up a new vet practice across the street and taking the clients. So those are some of the ways that you structure transactions. The other ways that you keep vets happy, first you need to pay them well, and I think CVS pays above average wages for their vets. Vets are also very interested in continuing education, advanced training so that they can keep more of their services in-house and don't have to refer those to hospitals. And I think CVS does a good job of providing advanced training to their vets. The other thing is vets want comfortable working conditions. And so one of the things that CVS has been doing is spending CapEx to improve their facilities that have cleaner break rooms and basically create a more desirable place to work. And then also offering flexible working schedules. That's super key. Something like 80% of the vets in the UK are female. They often have families. They don't want to work 5 or 6 days of work. 5 or 6 days a week. And so being able to offer flexible working hours is something that I think goes a long way in retaining loyalty.
Yeah, I know a couple of vets who are different from us. So my last one then is probably on choosing disinvestment CVS versus other opportunities.
Yeah.
There is in UK, there's the store called Pets at Home. They do pet food retail, but try to build an eco model with including vets services, and they are the same size in vets as CVS. So what was for you the reason to choose? Why is it more compelling?
Yeah, so I'll give you the quick answer. So CVS is a 100% pure play vet business, okay? And I showed you the M&A multiples, 18 times on average for a large group of corporate vets all over the world. Pets at Home is this business that it's a hybrid pet retailer, so it's like a pet store where they sell pet food, they sell pet accessories, they have a groom room where your dog can get a bath and get a haircut, and then they also offer vet services in those same retail stores. And so it's effectively a hybrid, half pet retailer and half vet business. The stock market historically has valued it as a pet retailer. And when I've also studied this. If you look at pet retailer M&A comps, there have been 5 big deals over like the last 8 years of pet retailers. And on average, the enterprise value to EBITDA multiple paid for those businesses is 10 times EBITDA. It's much less. And so in general, I prefer the pure play CVS, which is a pure play vet business, as opposed to the Pets at Home, which half the profits come from pet retailing. Pet retailing is more competitive because you're competing with Zooplus, you're competing with Amazon, you're competing with the grocery store players. And ultimately, when a consumer is buying pet food or buying pet accessories, it's price that really wins.
Thanks a lot.
Yes. Thank you.
Would love to continue.
Great questions.
Yeah,
thank you, sir. Enjoyed it.
We have time, I think, for one question.
Sure.
From the audience. Yeah, the mic is there. Yeah. But he's going to stay here anyhow.
Macro question, how do you manage the currency risk in your portfolio?
Yeah, so Tweedy Browne, most of our investors are US dollar-based investors, and so we're one of the few firms that invest internationally that fully hedges currency risk. And so, for instance, in a business like this where we invest in the UK, we're going to effectively when we buy the stock, we're long the pound, and then we enter into forward contracts to hedge the currency risk. Ultimately, what we've thought at Tweedy Browne is that we're really good stock pickers. And we have a view on, in local currency, what's the stock price and what's the intrinsic value. We have no idea, no clue on how foreign currency changes are going to impact an investment. And whenever you make an international investment, right, there's 2 returns. There's the return that the stock generates, and then there's the stock that the currency generates. We hedge out. So in this particular case, what we're trying to capture is the local market return of CVS Group in pounds.
Thanks a lot.
Yep.
Fantastic.
Okay, I'm back on salmon. So I'm going to discuss one of our biggest investments in SIA. I have divided the thing in 2. First, the market, because I think it's important to understand a little bit the salmon market. I'm talking about aquaculture and salmon farms. And then Lerøy Seafood, which is the stock we chose. So this is us in Bergen, in Norway, this year, trying to see what is going on. It's a local market. You need to go there and understand what changes may happen. So you see these large cages, 200 meters diameter, and normally you have 200,000 fishes there, kind of salmons swimming in circles. So it's a very, very interesting industry. I'm going to go through it relatively fast It's a good product. Basically, it is healthy. It has, well, omega-3 and some other ingredients that are kind of healthy, good taste, very digestible, and very convenient because you can do different ways to prepare it. So it's something that is overall a very, very interesting product. It is very efficient. So to sum up, the feed conversion ratio, it's how many kilos of feed does it need to produce 1 kilo of food, and it's 1.3, which compares very, very nice with chicken, with pigs, and with beef. So it's really efficient. Carbon footprint is the lowest. Water consumption is the lowest. In the end, you have an animal which has the temperature of the sea and is floating there. So the energy he needs, it's much lower than other animals. So very efficient food. It is a niche market. We like niche markets because you end up, if a niche market is a nice, small market, you end up in an oligopoly. And then it's small enough not to attract the big guys for competition. And this is what is going on here. The aquaculture, so the salmon farming, it's more or less now, this is an old chart, it's now I think 2.5, 2.6, 2.7 million tons per year, and beef is 72 million tons, pork is 122. So really it's a small market. Strong demand. So, you know, that's from a practical perspective, demand has been growing 8% for the last decade. And then Kontali, which is a consultant, they did an analysis at a flat prices, growth is 6 to 8% per year. In Europe, we are the most salmon eaters, we eat a lot. Japan, US also, but US is half of Europe. And then emerging market, nobody really eats salmon, farmed salmon in the emerging market, so penetration is very low. So the potential of demand is huge. Limited supply, so huge demand and limited supply. Why? Because you need specific natural conditions. You need seawater, obviously, fjords, because they need calm waters. You need a specific current in order to take some of the waste. And you need a temperature between 8 and 14 degrees Celsius. And then you need industrial conditions because you need concentration. There's, you know, biological risk, so the fish get sick. And you need concentration, you need regulation, and you need a supply chain which is verified, certified, and that works well. If you look at the geographies, you find if you bend the slide, you will see that all of the sites are in the same latitude. So you cannot go north or south because the temperature either is too low or too high, and then the salmon doesn't grow. So this limits the supply. So this is a typical site, 1, 2, 3, 4, 5, like 10 cages. You can do the multiplication, multiply by the 200,000 per cage, and then you need, you know, calm waters, currents, and temperatures. And this is a risk. This is a nasty picture. It's sea lice. It's a crustaceous, I think. But you have jellyfish, you have pancreas disease, you have anemia, algae bloom, so there's plenty of virus and different things that can attack the salmon. And you know, it's 200,000 fishes there. So if one gets the virus, the whole thing gets the virus, and you can really kill everyone. Actually, Chile has had 2 large crises in the past 10 years. This is a bit old, so maybe 15 years, where they lost the production for the country. So it's really very important that to have controls, sanitary controls. So regulation has been implemented. The industry 30 years ago was new and has been evolving and standardizing and industrializing, and now it is industrialized. So they have a maximum allowed biomass in the sea. They have a license system in Norway and in Chile, and there is a traffic light growth model by which if the biological conditions are good, you're allowed to grow. If biological conditions are bad and the fish is not in a good condition, you're not allowed to grow. And Chile has basically followed the Norwegian model. So limited supply growth, you can see what is the past. So this is a fact, past 10 years, 3% per year. Remember, demand growing 8%. And in the future, this is Kontali, the estimates are 2% growth. But I mean, you don't need to be really very, very insightful to see that this 2, 3, 4% is the maximum. And this is the reason Norway is 50% of the production, and it's fully, I mean, the capacity is full, they cannot put more. And Chile is 25% of the total production globally, which means 75% of the production globally is already in a mature level where growing production is going to be difficult. So high demand, limited supply, the adjustment will come via prices. And it's what we call a change of regime. If in your life of investor you find that change of regime is the best way to make money, it's a sector that changes structurally, and this is a good case. It used to be a cyclical sector when it was growing, so a lot of supply and new standards, blah, blah, and very cyclical, so more fish, lower prices, less fish, higher prices, but it changed when the capacity just peaked or matured, right? Average sector return on invested capital, 12%, at an equilibrium price in our numbers, which is now more 90 Norwegian kronas per kilo, around 8 euros. Risks, new forms of offshore. You can see here a kind of rig that has been remade in order to go offshore and withstand higher waves and try to develop the business, not in the fjords, but, offshore. It is not really working as expected. It's taking many, many years and not working well. And yeah, maybe one day it will work, but in our, visibility, 5 to 10 years, there's really not a lot of capacity coming there. And then what they call containment systems, so which is completely closed systems. This is not working either because both of them are more expensive, so you need higher prices, you have higher costs. There are models that will come when prices are high and then returns can be bigger. Risks too, onshore farming. This, in my opinion, not very ESG compliant, but you have big projects on land where they build huge swimming pools and they create the smolts there and they develop the whole value chain. CapEx much higher, costs also higher. You need to keep the water at this temperature. And then also there are risks because this is biology. Biology is not an algorithm. So you have issues, you have virus, and if you kill the whole production because you get a virus, the whole project's bankrupt. So there's a risk there that this kind of a startup risk, it will take time to bring also supply. Investment case, Lerøy Seafood. This is one of the leaders in Norway, 200,000 tons, 2025, market cap 2.3 billion, more or less, net debt 800 million. EBITDA margin, now it's depressed 15% more or less. They have 100 farms, and it's a tier 2. So there's 2 companies that are the top guys in terms of cost and returns, Mowi and SalMar. These guys are kind of top 2, but it's good business. They are vertically integrated, which is good. So they do from the egg to the smolt. Smolt is the small fishes. Then they grow in the sea, and then they do the processing, and they end up with even salmon, packaged salmon. So they do the whole chain because they want to, to get more direct contact with the end client. They've been investing in there for 10 years or more. Volume growth, no surprise. This is not a growth stock. It's going to be 3%, has been 3%, and nothing to comment here. In the past, there's a bit more growth because there's some pricing here, but in volume, so total revenues grew more, but volume, we shouldn't expect much more than this. There is huge cost inflation because of the feed. The feed is also based on sea products, kind of fish meal and fish oil. So there's some inflation. You see that inflation has been 7% for the past 15 years. They are coping with that, but in our view, cost will pass to the end consumer because the market structure is quite oligopolistic. This is a target for this year, lower costs, 205,000 tons, conversion rate. So, nothing very surprising. Strategy for them, they are building facilities of post-smolt. What they want to do is from 0 to 500 grams, they want to farm them onshore because then you avoid a biological risk, keeping them onshore, and then they put the fish in the sea with 500 grams. Historically, the fish was put in the sea very early, but then you have higher risk, and then you have a higher inventory cycle. So more time in the sea, more risk. Now they're building facilities in order to grow the fish and then put it in the sea, and you lower the biological risk. It's called post-smolt. Second one is technologies. It's amazing how this industry, which looks like kind of very basic, they're investing in remote farming, they're investing in growth centers, they have even lasers to kill sea lice. So sea lice is a kind of a small animal, and they have lasers to kill them. So, and this is every year it's surprising how they are improving. And the final strategy is the semi-contained system. So they don't want to put the egg system, which would be fully contained. It's a hybrid. So it's a platform that goes up and down, and the fish there, they can take it down 2 or 3 meters because the sea lice is more in the surface. And there's plenty of initiatives in order to avoid illnesses. Now, more or less 1/3 of the production is already in this type of semi-contained systems, and the plan is to have 70% in a couple of years and then 100% long term. And the reality is that the sea lice problems and biological issues are down a lot with these systems. Conclusion, it's nothing really surprising. It's a salmon farmer. Value chain developed over 20 years. Revenues grew a lot because of pricing and when the industry was growing, but now growth will be lower. Return on capital employed, 17% on average. And we think it's an attractive sector due to this, due to the consolidation and then the impossibility to grow supply. This is why the government put some extra taxes. Every time a good business reflects that in the numbers, normally in a commodity space more, the government gets there and puts some taxes. But this is not going to change anything because tax is going to be cost and cost is going to be passed to the end consumer. Valuation, so it's a 4G. You know that we use the 4G, good business, good management, good balance sheet. Net debt EBITDA, I think, is 1.5, something like this. P 2026, 9 times. We do a DCF, our intrinsic value is 80 NOx. Now the stock is 44, and the IRR is 18%. So, but 2027 P of 8, and now the salmon prices are very depressed because this year has been very good in terms of temperatures, and everything has worked very well. And there's a lot of biomass in the sea, which means a lot of supply, prices depressed, stocks go down, spot prices go down, and stock prices go down, which means that Lerøy is in a perfect moment to buy it because it's cyclically depressed and structurally you have all the upside in the spot price, in the margins that on average should be more 25% EBITDA return. So, it's a heavy weight for us. I think that's it for me. Thank you.
That's gestartet.
Wow.
Oh.
That was very fascinating. Learned a lot. One of the questions that I have, I saw an $80 intrinsic value estimate, and I think the stock price was in the low 40s. Low 40s today. Can you walk me through how you get to 80?
Sure. I mean, basically, what we call it 360, which is basically maybe what you do. So we always do a DCF. And the key for the DCF is stemming from Buffett when he says, or all the value school, they say intrinsic value. What we do is converge the model, right? So you look at the historical margins, historical returns, and then you build a model where, it's in the middle of the cycle.
Yeah.
Then, obviously, this is a commodity. So the main problem for a commodity is what is going to be the price of the salmon, the price of the commodity. Right. And then we have our theory where the equilibrium price is, which basically is the return, the return you need for new supply to come. So you calculate what is the return of the new supply, and you have the capex, you have the cost, and then you calculate what is the price that is going to incentivize more supply. And this is what we call equilibrium. And the price in the stock market or in the market is never there. It's always below
right.
or well above in the commodity space, like in oil and like in copper, etc. So basically, we use incentive price, we do RDCF, we take out an IRR and an intrinsic value. But I don't like to depend too much on one thing. So we do PE, EV, EBITDA, all the whole, we call it 360, and we call that also historical, trading multiples, and M&A. So, you know, so you get a lot of different valuations, and basically common sense tells you, okay, this is the price. And we have 80. We've seen this at 80 already. Historically, the PE on normal times is 15 times, which I consider normal, so I wouldn't pay 25 times.
What's a normalized EPS?
So, yeah. You know, big picture, EBITDA now is 16. I think on normal conditions should be 22, 23%. On the high end of the cycle, when the price will go to 120 Norwegian kronas, it's going to be 30%. This was the past, which means that basically easy 25% more EPS should be done on equilibrium prices.
Okay.
So if we take the PE, which is 9, and I raise prices, probably the PE is maybe 7. So this would more or less match the IRR, you know, with 1 divided by 7, you're already 16%, plus a little bit of growth. So this makes sense. We always try to match all these calculations in order not to just depend on one thing and then you're wrong.
Right.
So, you know, the EBIT margin should be complying with the return, should be complying with historical return, should be complying with everything. And in this case, I mean, one question, if you were the owner of this company, having the license to produce these tons of salmon, where you don't have competition, at what price would you sell the business? I mean, I wouldn't sell it, I would just keep it forever. So 15 times, we think it's good enough with some more EPS on normalized earnings.
And return of capital here has been primarily dividend, right? They're not buying back stock. They've been paying an above average dividend.
It's one of the negatives of this industry is that it's not really, the corporate governance is not the top.
Not the top,
So most of them are family companies, or some of them, this one is a family company. Sometimes they think long term, maybe too much. Maybe they do investments that they should be a bit more disciplined. So in these semi-contained things, maybe you should not test everything. So, but you know, it's a family, and we think it's normal. You know, family companies, they invest very long term. They don't care that much about all the metrics we use in the financial market. So probably they could be more intelligent buying back shares like now, rather than investing in new things.
So that's a great point, because this is something we've done at Tweedy a ton, is trying to convince companies that at certain points in time, you need to have flexibility in terms of capital allocation. When your stock is really cheap and you've got a good balance sheet, you don't need to borrow the money. Share repurchase makes all the sense in the world. There are other times when the stock's expensive, or maybe you don't have as much balance sheet flexibility that a dividend probably makes more sense. Have you ever tried to, maybe in a polite activism way, teach the company that, hey, they could actually create more shareholder value over the long term by, when the stock is cheap, pivoting to share repurchase, and when the stock's more expensive, paying a dividend?
Yeah, absolutely. Well, I've tried. I have suggested them, and the other guys, the other CEOs, I suggested them, why don't you stop growing that much? Why don't you just focus a little bit more on biology, on sanitary conditions, on really quality production? Don't try to go offshore. Don't try to set up new things to be the #1 in Norway. And they look at me like, this Spanish guy, I mean, what are you fucking saying? We want to be the leader. Right. So, you know, it's a sector which is not really yet at the full speed in terms of financing targets. But it's very interesting because they will do it sooner or later. And in any case, the returns are good enough. So the risk has been taxes. So the government has just imposed higher taxes, and now there's new regulation. So this is another reason why the sector is a bit cheap, is because the government is analyzing the regulation. They want to reduce the biology risk, which is good. In the end, it's good for the big companies. It's going to probably harm the small players. So long term is going to be good. and we expect a professionalization of the sector in the next decade. But you know, I have nothing to say if the CEO says, no, I'm going to invest in these new technologies rather than buy back. Okay, you know, I understand, it's your call.
That's right, that's right. Awesome. Thanks a lot. Thank you very much.
So you see here with our red bars when we buy stocks, and you see that we constantly could increase our fair values on Sonae given their value creation. But that's not the reason why I'm here, that I present you Sonae today, because it's an example that has worked out well. It's rather here about this situation right over there. You see that the stock price came above our low case of what we say could be the fair value of this stock. And because at BWM we try to be disciplined not only when we buy stocks, so we try to buy it at 60 cents on the dollar, but we also try to be disciplined when it has reached its fair price, we sell the stock. You see that a little bit evidence also here in 2022 that we sold a little bit of the stock when it approached our fair value. So that meant for us, I did have to take a review of our investment case. And now I'll explain to you how I ended up with the higher fair value, and I'll tell you at the end of the presentation how much is now our fair value. But first of all, what is Sonae? So in the mid-80s, there was Belmiro de Azevedo who took control of a wood panel company. And he used the cash flow to build one of the largest companies in Portugal. Sounds a little bit familiar to Berkshire. You should, the IR is here today with us from Sonae, and probably you should switch the narrative that is the Berkshire of Portugal. In 2007, Belmiro handed over leadership to his children. So today, his daughter Claudia is the CEO of Sonae, and her brother Paulo serves as the chairman. The family owns roughly 56% of the shares. And so when we invested, our key question was, what motivates the Azevedo family? Are they just empire builders? And we saw then, no, actually they're constantly reshaping the portfolio. They're willing to sell down assets. Or the other thing is, they see their role more as being a socially responsible company, given that Sonae is the biggest private employee in Portugal. So we did some due diligence calls with former managers, and what they suggest is that the Azevedo family is primarily focused on returns, efficiency, and value creation. That is clearly reflected here in the development of the last 25 years. When you look at the portfolio today of Sonae, it's very attractive. You see here, it's very balanced. It's in sectors that are regarded as highly defensive, so they are in food retail or real estate or telco. And the NAV of this portfolio equals to €2.36. And this is a number that Sonae calculates every single quarter. And you see here on the right, the reason how they did value those assets. And what they did was always take a conservative approach. So it's either a peer group, it's invested cash, it's a current market cap. So today's share price of 120 is close to 50% discount to this this NAV. So incredibly high from this point of view. The most important part of Sonae is their food retail business. It's a large food retail company in Portugal. And let's have a closer look to this business because it's half of the value. Continente is the leading food retail in Portugal. It has a market share, very high market share of 27%. But beyond that, they're strong in all key areas of a good retailer. So they operate all kinds of formats. So they not only have those hypermarkets, they have also as well as strong convenience stores. They're strong with franchises. They have a very strong market share in online, in e-commerce. Then they are incredibly strong with the loyalty card program. So they have a lot of data about their customers, much more than anyone else, and they use it very intensively for promotions. Very strong armor for them. And they've created a place that really feels very, very alive. So I visited this store on the right 3 weeks ago to meet the management team. And you see here in the back, you see here a section with the fresh juices. But if you go into this hypermarket, this Migros-style store, you have there a sushi bar, you have a coffee shop, you have live bakery, you have just everything that feels very vibrant. They have also a very excellent selection of fresh products. You see here my photos from the fish assortment, and that's very important in Portugal to have good fish, as you might imagine. And I was deeply impressed. It felt going here through the fish section felt more like being on a fresh market than in a supermarket. Well, that might be an expensive place, but actually it's very highly competitive. So discounters like Lidl, they don't have a clear price advantage over Sonae. So how does Continente perform with this kind of concept? Very well. Continente has more than doubled their revenues in 10 years. This is the blue line. And that, despite the market entry of the leader from Spain, despite the market entry of Mercadona 6 years ago. And it's also good to see that those revenue growth comes with profit growth as well. Let's see that in the green line. Sonae compares, for the calculation of the value of that, Sonae takes a peer group with 5 food retailers from Europe, and how does it compare with them? These are the five retailers that they picked. And you see here in the first chart the organic sales development over the last 10 years. Organic sales, we call it also like-for-like or comparable sales. That's actually, that shows you how well an existing store base, how well they are performing. That's probably the most important measure for a retailer. And you see in the earlier years, when Portugal still came out of their debt crisis, that they were below the group. But for a couple of years now, they are actually clearly outperforming the peer group. That's the average is the blue line. It's every year that they're performing 1% better in like-for-like. And even they're more stable than the others, I would say. In fact, so Sonae's food retail segment actually should be asked for a higher multiple compared to the peer group. It shouldn't be valued at the same multiple from that point of view. And then when it comes to margins, Sonae even clearly leads the pack. The food retailer make on average 3 to 4% margins, but Sonae is performing 5%. This is significantly higher, and that means much more cash generation than the others. Reason for that is the Portugal market is a little bit more rational than other markets, I would say, but it's also the outstanding business models from Sonae that makes them perform so well. So this is the second reason that actually should ask for a much higher multiple than the peer group. So going back to the NAV calculation now of Sonae. So they take a multiple of 6.6 for the peer group. That's the market multiples right now for that. If we say 7.6 times EBITDA multiple is a more appropriate multiple for this better performing business, the segment is worth 600 million more instantly. And 7.6 times is still very realistic, so valuations above 8 times are not out of reach for a good food retailer. I think Walmart is above 12 times. I don't want to compare it with Walmart, but there are a lot of good food retailers that are trading way above. We can also argue look at the rest of the portfolio. I take here as an example the real estate arm of Sierra. Might be worth substantially more. Sonae uses the NAV, so the worth of the real estate there. But you could also apply here now a peer group multiple, like Klépierre and others, and then you would easily end up with 300 million more of value. So if we still take robust valuation assumptions, we end up with another 45 cents to the NAV. That's 1/3, 40% of current market cap just on top. It's therefore absolutely striking that you always could get Sonae with such a steep discount of between 40 and 60%. The last 10 years, you always had a huge discount. And for us, it's very striking because, as I said at the beginning, Portugal is actually now doing much better than 10 years ago. So discount should reduce a little bit. The NAV, or the shape of the portfolio, still has growth potential. So it's actually in better shape than before. And as I said, the NAV calculation is very conservative. So after my review, we believe the discount rate is just too high going forward. So I came back from my meetings with the management and stowaways in Porto, and mainly with the following thoughts. So the most important asset, that's Continente, and that convinced me much, much more than I would have expected before. So if this store would be in Switzerland, that would be my favorite choice. The CFO, he told me that actually they want to grow the NAV by 13% per year. That's the ambition. If this value creation becomes true, actually you should be willing to buy that for a premium and not for the huge discount. And the final thing was management also seemed to be really committed to further crystallize value, for example, for food retail or for Sierra by doing, for example, an IPO. With that, we now apply a 25% discount to the official NAV to our fair value. Why 25%? That's just more in line with other conglomerates in Europe. But I truly believe Sonae will continue to create a lot of value. So I think this is still a very compelling opportunity. Thank you so much.
Not so agile.
Yeah, we have to be. Let's try to do that quick. We want to sit here.
Okay. Pascal,
Okay.
thank you very much. It's a wonderful presentation, wonderful firm and family. We, as a Spaniard, we know well that firm. We know well the family. We have been investors in the three, both in the holding and the two subsidiaries. And given that Continente is really what it really worth on your presentation, and the delta, the higher delta is precisely what you consider is worth more, let's focus on that. No? And the first question is, how do you weigh the entry of a rival from Spain? Mercadona is my favorite company, my favorite CEO. It's not listed. It's private with Juan Roch. It's like the Walmart family. It's an incredible guy. How do you weigh the appearance of that competition, new competition in Portugal from a rival like Mercadona? A rival that it's put in very huge difficulties to Lidl and Aldi in Spain. They acknowledge they cannot fight with this guy.
Yeah. So I think they entered, in 2019 they entered the market, and in that time they really built 8% market share in those 6 years. And Sonae, or Continente, at the same time, was the only other player who gained 1% of market share in that time. So the losers were the others. They told me that what they had to do is really, they have a very high regard for Mercadona, so they knew that there is a threat. So what they did, they really leveled up the store operations. So today, most of the stores are refurbished. They saw that Mercadona is very strong in private label, so they really leveled the private label very much, so that's highly appreciated by the customers. They have the secret weapon of this loyalty card, so they can push out more promotions, etc. So I think the other guys probably didn't have all these to fight against Mercadona. And you see that, you saw it, the results in terms of sales growth and with operating margin, it was still pretty good in the last 6 years. I would say going forward, that will be still, they will have to keep on fighting with them, for sure. Yeah, but so far, 6 years, they do well. Probably there was also a little bit, the biggest part of Mercadonna's growth, maybe they have also a little bit peaked now, because there was a lot of buzz. Probably the first entry is really more easier than the next step, but still, it will be, they will take care of Mercadona. They will take that as a big threat.
Good. Well, it is a family-owned business, and the Azvalor family owns more than 53% through Efanor, I think, no?
53 or 56.
64. We have had very good times with them. I mean, investing along them, but I'm sorry, Beta, that you're here. But we had a bitter relationship or a bitter experience on Sonae Serra. They launched an IPO to take it private after the COVID, when the stock had dropped more than 60%, you know. And they offer a nice price compared to the market price, but we all knew that it doesn't represent Serra, that it was in your presentation, the entire value, not even a discount, a reasonable discount of what they, you know, what they pay. It was a hard discount of what they was really worth. No? So we tried to make them see that they could improve or consider stakeholders that had been there in the tough times, but they ended up taking it private. How do you weigh what's the relationship with your family, the Azvalor family? How do you?
Yeah. Well, in general,
you're a minority stakeholder, no? And they own the majority.
Yeah. Well, first of all, I think that's one of the biggest risks that we have as deep value guys, that we invest in something deep value and someone else comes and grabs the opportunity and we don't really get the full value for that. That's for sure. I think that transaction was during the COVID time.
Yeah.
And I think it was probably also not, how big was the transaction? A couple of tens of millions or hundreds of millions?
Don't remember, but
Yeah.
they paid 70 cents. Yeah.
So our position as minority shareholder with Sonae, I think there are a couple of other things that you have to criticize them. Probably their board is not really a very independent board. They should also reflect the minority shareholders as well there. But the overall value creation over the longer term, you just participate with that. And the other thing is they also do a very good dividend policy. So I think currently it's 5%. It's always growing by 5%. The only point here is what Jay was really saying about buybacks. They never do buybacks with that relation. That's really a pain point. The other thing, sorry to hear that with the.
Okay. And finally, the business model is based continentally basically on, you mentioned there are some other formulas, but it's based on hypermarkets. It looks like the pattern of consumers is changing to proximity, e-commerce, supermarkets. How do you weigh the speed of that change, how well protected they are to attend to these new type of supermarket models?
Well, I think it was, hypermarkets have tough times in many markets in Europe, and I think they have already diversified a lot. So if e-commerce would grow substantially, which just they don't do in Portugal, but they own more than 50% of the e-commerce market is theirs. So if that grows, I'm fine with that. On hypermarkets, I think Portugal is a little bit different from other markets. I think Portugal doesn't have really those high streets. Portugal doesn't have this. If you look at the US, the store per capita is 6 times higher than in Europe, and especially also compared to Portugal. So, and what I said, they did a lot to level up a little bit the customer, the value proposition for the customer. So it is, of course, things are changing. Probably in Portugal, not that fast like in other markets. That would be my first, a little bit my view on that.
Because it's challenging to keep this 5% profit margin.
Yeah.
It's very challenging.
Yeah, it is.
Okay.
I agree with that.
We'll leave it to the audience. Perhaps they've got a question.